Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast is titled The Current Investment Approach of an Allocator and Family Principal. Our special guest today is Marty Gross. He is a professional investor, a family principal, an allocator, a variety of words we would want to use. How about, Marty, that I use one that really gets to the point? How about a mensch?
Okay.
That's it. For those that don't understand, that means a great guy. You probably got to be in the New York area to kind of really get that. It's a little bit of an inside thing. Well, Marty, it's a tremendous pleasure to have you on the show. It's always an extra treat, if I could use that word, when we have someone who, it's great to have on economists and professors and thought leaders about academia, and they're great. I like to interview them as well. But there's nothing like someone who for decade after decade has been a successful professional and private investor and a family office themselves with the successes that they've had as an investor. So that's always a little extra cherished when we're able to coerce someone to be on the video and be on the show. So Marty, it's great to have you here.
Great to be here.
Let's get right to it. So if we're talking about the world of investing, it would probably begin foundationally with you have to understand kind of what goal you're looking to accomplish with investing. What's your time horizon? What's your risk tolerance? What are some of the parameters? What professionals may call an investment policy statement. Now, you have it a little differently, but conceptually, it's effectively the same thing. If you could talk a little bit about what that means to you.
Sure. Well, nice to be here. Thank you for having us. We approach the investment of our capital as having a purpose, and it is to maintain lifestyles. It is be able to give away money, and therefore we try to grow the capital cautiously, without an interest in making outsized returns because we don't want to take outside risk. We don't have to take outside risk. So let me just say a couple of things that go into that particular view. The first is that we, as one of our more famous hedge fund managers said, we recognize that there are going to be times to make money and there are going to be times not to lose money. So we have to think about that as we're investing. Which times are they? We also understand that, let's say you're a very, very wealthy family and with a huge amount of money that is much too much for anybody to spend, including extended families. At that point in time, what one has to realize is that there's an asymmetry between making the extra dollar and losing a substantial amount of dollars. Okay, so I'll just take an example of a family that has a 9-digit, investment portfolio. If they make 8% one year as opposed to 9% one year, it doesn't really matter. If they lose 20, 30, 40% of their money, that really matters. So therefore, the one thing we always think about is we never want to take outsized risk when there's a chance for substantial loss, because it's much harder to make that back. And that additional point or two in the context of that type of, that size of money doesn't have significant marginal utility. The next thing we think about is that there's a skill set problem that many families forget. And that is that if someone was very, very successful in a business that was not an investment business, let's say they made widgets, and then they sell that business for a very significant amount of money, too often people think that because they were successful in one area of business, they would be good at investing. We see that mistake a lot. So we try to, when we end up counseling other people, get them to see that investing is its own special skill set, very different than other types of businesses. We look at the macro environment. We're in an environment right now where there's very, very substantial printing of money. And that makes us think about the concepts of inflation as we invest. It makes us think about, gold. We've never been a major gold bug. We hear people that say, I have to have a 3% position in gold. But if it doubles, it doesn't make that much difference. So we have to remain aware of the macro environment. And, now we're seeing the potential for very, very serious inflation given the money printing. And so we have to take that into account when we decide where we think we want to allocate dollars over the next many years. The other thing about managing large sums of money is that when bad things happen, when there are crises, whether it was the tech bust or whether it was the financial crisis or whether it was a very, very bad March, you always want to manage your money so that you can always live to fight another day. What that means is we are extremely minimal users, if any, of leverage, okay? You can have strategies that work for decades, and in a week or two, you can be literally wiped out. If you have too much leverage and you're there at the wrong time and you're forced to sell just into the markets you don't want to. So one of the policy statements, one of the components of our policy is basically no use of any kind of material leverage. We also recognize that managing money is a learning process. And so you kind of have to go to your office every day and saying, what can the world teach me today about what I don't know that I do have to know to do this successfully? So that's kind of like an attitudinal component to our policy statement. We look back at crises. We want to see what happened at different times when there were crises. So we want to see what happened in the tech bust and how that hurt people. We want to see what happened in the financial crisis, who survived and who didn't. We look back in March of 2020 and we see which particular funds that had been around for a long time incurred extremely serious permanent loss of capital through the use of leverage. We also bear in mind that equities are very, very risky. If you want to be in long equities, you are in an asset class that over the last decade or two lost 49% before it came back, then lost 57% before it came back, and then it lost 35% until the Fed intervened. So we are very, very aware of how volatile and how risky equities can be. Having mentioned those different types of considerations, and there are probably more, I'm sure, that we take into account on a daily basis, the two words that really come together for us to sum everything up to the extent it's summable is essentially being measured and being dynamic. You have to dynamically manage money because you're operating in an environment that's always changing, and you have to be measured because you have a lot of time if you have a lot of dollars, and you have to make sure that you always try to avoid any significant permanent capital loss. In terms of the allocation that we have, this is intended to reflect the above principles. So the main principle is reduce and control risk. The second principle is always have a cash cushion because things can happen that you never thought of. I'll give an example of that in another second. And then the overriding principle is that most people who got rich, in some cases they were lucky, in other cases they were born right, in other cases they worked very hard and they weren't lucky. However it happened, I think most people can agree that you never want to have to try to do it a second time because you just don't know whether the world will accommodate that. Okay, so with that in mind, let me go into how we put our portfolio together. So there's no magic to this. There are some things that we do, and there are some things that we don't do. Sometimes we don't do things perhaps that we should do. There are certain things that if we're not comfortable with the strategy or we don't understand it, we just don't do it. But that's okay. Remember, this isn't about recreating the wheel. This is about using existing tools, existing asset classes that allows one to achieve a purpose and achieve a goal. Okay, so let me quickly run through. I'll spend about 15 minutes going through this, and then we can open up for questions. And if none, then we can take it in another direction. But we basically have 8 different buckets that we invest in, and these reflect our comfort level. They reflect degrees of knowledge that we can have about each particular bucket that leads us to believe that we can be successful in investing in in that asset class or in those strategies. So the first one is cash and bonds, okay? Now, this is about return of your money before return on your money, okay? We just had an experience, and we have, let's say, between 7 and 10% of our assets in that category, which means that's going to be a drag on performance, because performance of cash and bonds today is very, very light. And when I say bonds, I'm looking at, 1 to 2 year, maybe 3 year, high quality investment grade bonds. And what we intend to make on that is whatever the market's paying us. We don't expect to trade that. We don't want to try to get any alpha out of that. That's just what that is. And one of the reasons we need that, and we might even increase it after what happened in March, we don't know, is we had a very uncommon experience for us. We're an investor in a lot of apartment houses we've had for many, many years, just as a passive investor. And for a short period after March and into April, we had governors that were telling people, if you were a renter, that you couldn't be kicked out if you didn't pay your rent, okay? That was quite extraordinary, because it kind of went to the gut of the contract between the landlord and the tenant. And we didn't know at that point in time whether we might actually have a capital call to be able to pay the mortgage on apartments that we had owned for 20 and 30 years. It had never occurred to us in our wildest dreams that on an asset so stable with maybe a current mortgage of 20 to 30% loan to value, we might even get a capital call for that. So we had it wasn't even in our imagination that we might need to come up with cash to preserve an asset that we had for 30 or 40 years that currently only at 20 to 30 cents on a dollar of the worth was a mortgage. Now we never had those calls, but it was a wake-up call, so to speak, that you just never know what can happen out in the world that you might need cash for to protect assets. So that's why we keep the cash in the bonds. We would probably never let that go to zero, even though it's not earning that much. The next category we have is long equities, okay? It's very difficult to find an institutional portfolio that won't have long equities, okay? So the choices we make here is, do we want to index or do we want to go active? In general, most people that try to go active managers don't beat the S&P 500 index. That's a little bit of a situation right now because of how heavily weighted it is toward a small number of companies. But we have to recognize that even though the long-term return from an expectation perspective, from the equity allocation, even though the long-term return from US equities is about 10% a year, pre-tax, pre-inflation, and inclusive of dividend, there have been lost decades. So an indexed equity allocation from 2000 would have resulted in a 10% loss, give or take 10 years later, okay? The next thing we think about in the equities is there's been a lot of people that have done studies of what rate of return should I expect from equities given a starting point defined as PEs and earnings, okay? Those are interesting. Sometimes they work, sometimes they don't, but we try to take a look at them to get some idea of what a return expectation would be. But generally speaking, we think that while it's a nice exercise, it's very, very difficult to do. Right now, there's a strong case that going forward, equity-like returns for the next many years are going to be below the historic return. On the other hand, with the Fed doing what it's doing, there's simply no way to know in our view. So we keep the allocation because we think it makes sense. The third bucket we have is hedge funds. Hedge funds is our largest allocation. It's a give or take 40%. Now, what are we doing when we go into hedge funds and why do we do it? The first thing is there's no such thing as a, quote, hedge fund. There are hedge funds that do this as opposed to do that, as opposed to do that. So the first thing that we do in terms of deciding how to build out the hedge fund allocation is look at the different kinds of strategies that exist in the hedge fund space. So there's long short equity. I'm sure you guys know this is long short equity. There's distressed credit, there's macro. The strategies we've tended to put the overwhelming percentage of the money in are some long short equity, mostly activist-oriented equity or credit. And then we have a couple of managers who can do any of that, and we're really making people bets as opposed to asset class bets. Let me move through the allocation, that we can come back to that if you want. The fourth bucket we have is lending, okay? There's a huge amount of lending funds that are out there now. Some of them are good. Some of them are good doing dangerous things. Some of them are good doing not so dangerous things. So when we think about how we want to allocate dollars into lending, the first thing we do is recognize it's probably not very tax efficient. And so that's where we would use non-taxable accounts, either pensions or profit sharing plans or foundations. And then we think about, the question is, how do we decide among lending funds? The first thing is that we almost always want to be in the senior position. So we don't want to do mezz funds. Generally speaking, I'm not saying no mezz funds, because if the senior position is only 10% of value, it's okay. But generally speaking, we only want the senior position. We want, give or take 50 to 60% correctly assessed loan to values. We want the right kinds of covenants that the managers put in. We want the right fee structures. We don't want to pay fees on capital plus the levered portion of that asset, so that if someone puts in $1 and the fund borrows $2, we don't want to pay fees on $3. We only want to pay fees on capital. We only know of one large fund that charges fees on the margin amount. We're not in favor of that. We generally do not want leverage in our lending funds. We want them to be unlevered. Occasionally there is some leverage, but it's depending how it's structured. But in general, we don't want to need to goose up returns through leverage. We want to be very, very comfortable with the kind of collateral the lending fund has. We tend to focus much, much more on real estate related collateral than on corporate collateral, because it gets very complicated when you try to figure out the right multiple of EBITDA to put on a business to see what loan to value you're really exposed to. It's less complicated in many cases if you're figuring out what the value of a particular property is that you're lending against. So we tend to favor real estate related collateral as opposed to corporate collateral. Okay, the next allocation, and I would say our lending funds would be under 10%. To some extent, we consider that as part of a bond portfolio, but not from the perspective of liquidity, but it does enhance the returns a little bit. So the fifth of the 8 allocations is private equity. We don't do too much of this. Right now, we're very concerned about the valuations. We're very concerned about how much money is out there seeking deals. We talk a lot to the few private equity managers that we work with to ask them, so can you buy at reasonable prices today, or are prices still pretty ridiculous? One of the things that we do in the private equity space is we do invest in some secondary funds, depending upon who they are and depending upon the multiples at which, the prices they're paying. We don't want them to have to use financial leverage to generate the returns. Generally speaking, in PE, we go for smaller funds. They could be sector funds. Most of the money in private equity, though, is not in 5 years in and then 5 years out, as opposed to 2 years in and 3 years out in distressed opportunistic situations. The next 2 categories are real estate. The first category in real estate is individual properties. So we buy these one at a time with a number of groups that we've worked with, almost only multifamily, only because we consider that one of the most, if not the most cautious asset class. We were never a fan of office. We were never a huge fan of hotels. That doesn't mean we wouldn't do them, but that was more of an operating business. And so we have a very significant allocation to real estate on a property by property basis. We will very often take a slightly lower cash on cash return in exchange for a much higher quality property. We very often will buy a 5 or 6% or 7% cash on cash return, as opposed to a 10% cash on cash return we see other people offered, when those are C properties and we can buy, B to A properties at slightly lower cash returns. The next bucket is also real estate, and it deals with funds. We invest in real estate through private equity funds that only do real estate. And this allocation is broken into 2 different buckets. The first bucket are allocators. These are firms, whose names I'm sure you've heard of, where they will invest both in the US, they could invest outside the US, and there are many, many different kinds of asset classes in real estate. The negative to those firms is the fact that when they joint venture with local operators, you're paying a second level of performance fees. However, in some cases, we're willing to do that, given the fact that We think the teams that run those allocators are so talented that in spite of the fees, they can still generate for us, give or take, a 15% net return, which is our target for those types of funds, 15% IRR with a 1.8 to 2 times multiple on the cash. Now, the first bucket, the first group in that bucket was what I said, allocators. The second group is what I call local operators. So these are individuals that are usually running smaller funds, and the real estate they invested is more targeted. So we have one of them that's Florida-based, that's concentrated, and in that particular instance, we share in the general partner promote that they get when they bring in allocators as part of our third-party allocators as part of our investment portfolio. So we have a Florida-based fund, we have a Northeast-based multifamily fund, a Midwest fund that just does 3 cities in multifamily, a tri-state, New York, New Jersey, Connecticut fund in multifamily, a red state mobile home fund, a national hotel value add fund, Midwest senior care and hotel fund, and a small allocation in an office concentrated fund. So what having the local operators as part of this portfolio allows us to do is to target asset class within real estate and target geography. The last bucket we have is venture capital. And this is a relatively new allocation for us. I was perfectly unsuccessul until a number of years ago in venture capital, because every time a friend of mine would say, give me a couple of dollars for a new company he was putting together, it would grow wings and it would fly away and I wouldn't see it again. Very small allocations. And that was just, small little, very small amounts for friends. What's happened over the last couple of years is that through the connections we have with other family offices, some of whom are formalized from a research perspective, we've built out a pretty good venture capital portfolio. It will be no less than 10% of our allocation, real estate being about 15%, the two of them. But the venture capital would be clearly less than 10%. But we want that portfolio structured so that it touches a number of bases. So what are those bases? Well, we want funds that are larger, and for us, a $200 million fund is large, okay? And we want smaller funds, where it might only be between $30 and $50 million in a fund. So we're willing to go to larger funds. Not that 200 million is the largest you can get, but we don't want them that much larger, and smaller funds. So we're willing to do the size of the fund. We want when we looked at our venture portfolio, we want to be in many different types of businesses. So we want to touch tech, we want to touch biotech, we want to touch fintech, we want to touch cyber, okay? So we want our portfolio in one way or another to include those types of businesses. We want to be in funds that touch the seed round, the early rounds, and the growth stages. So we want to cover the different stages of VC within the allocation. We want to get geographic diversity, okay? So we have funds that are based in the US, we have funds that are based in Europe, and we have funds that are based in Israel, because each of these different venture capital ecosystems is its own ecosystem. Now they do cross-pollinate, but in some ways they're a little different. So we want to pick up that diversity. We want to have funds that are larger and well-established, that have been like on their 6th or 7th fund. And we're also willing to do much smaller allocations to some first-time funds if we're very comfortable with the people. We're an active participant in sidecars. So usually when we have confidence with a manager and we get a chance to do a sidecar, we tend to say yes as opposed to no, and control the risk through allocation. We will also do, on occasion, one-off opportunities where if someone brings us an opportunity to invest in this particular company outside of a fund, we would consider it, but that doesn't matter. That doesn't happen all that much. We believe that there's, unlike maybe 10 or 20 years ago, there's a very, very budding, interesting ecosystem of younger, highly intelligent entrepreneurial managers in the space. And we definitely want to try to find some of them to develop long-term relationships with. Let me just make a few more points. Those are the basic buckets and how we think about that. Let me make a few more points. When we're done and we look at the allocation, we then do a look-through analysis. So we see in each of these different, we put all these different funds together in one bucket. We can see when we put it all in one portfolio, how much equity we have, how much credit we have, how much real estate we have. So we can break down our overall allocation among those buckets. We can look at our long and short exposure. We know which exposure is long and which exposure is short. So we can see how much of our dollars are both long and short. We can do a liquidity analysis. So we know that our cash and our equities are basically daily liquidity. We know that the hedge funds, let's call them annual liquidity. And we know that the rest of the portfolio will have probably less than annual liquidity. So we do a liquidity analysis. We want to have a biotech exposure. So we create a biotech exposure for ourselves through a number of these different buckets. So for example, we will have hedge funds that do biotech, okay? We want to be in some early stage biotech. So if we did early stage biotech, they could either fit into the PE or probably the venture bucket. So we would pick up biotech, not just in hedge funds, but we would pick up biotech in the VC bucket. And then we do have occasionally invested in one particular company. Maybe it happens 5 or 6 times every couple of years, where we would invest in a biotech company due to opportunities that come to us. And so that would be a one-off. So if we want certain exposures, we can pick them up in a number of different categories. We could, in theory, also have some biotech public equities. So we don't think about getting exposure like biotech necessarily through one of the buckets, but it can come through a couple of the other buckets. One of the things that we grapple with is definitely, in terms of the allocation and managing the money, is teaching the next generation. So that's always a very significant challenge. We're trying to deal with that. One of the other things that we have to understand is patience, because given an allocation like this, it is absolutely essential for us to understand that for a whole bunch of reasons, it's a certainty that some of these allocations during some time frame are going to be underperforming other allocations. So we must understand that that can happen, that we don't just jump to the top performing allocation, and that we have a rationale for keeping capital where we do in each of these different allocations. To sum it up, it is intended to look down before it looks up from a risk perspective. It's not expected to make the last dollar. It is intended to pay attention to tax efficiency when possible, although we don't want the tax to be the dog and the investment to be the tail. It's dynamic. The world is constantly changing. It might be changing a lot with November 2020 coming. That's not a political statement. That's just an observation about what will bring change, maybe, and with all the incredible money printing. So we're in a constantly changing environment. It's changing even more quickly now than I think in the past. We have reasons to be in these different places. At the end of the day, the most important thing wherever you invest is getting the people right, because bad people can hurt a good investment and good people can make a bad one okay. So with all of that, bit of a ramble through our allocation, let me just stop there, Angelo, and then we can take questions or whatever you want.
Marty, that was fantastic. That was incredibly insightful. I do have a lot of questions, and I also want to engage the live audience today via the chat feature, but let me get right to it. So you actually hinted at it there towards the end, going back to earlier on asset allocation. Professional investors would usually make a decision to being more strategic or being tactical. And you mentioned a reason why. There are certain asset classes that could underperform, but just because that's the case, it doesn't mean that you just instantly bounce out of them. But do you want to be locked in rigidly during a time like COVID where everything is changing? The answer is no. And the reality is it's probably a combination of strategic and tactical, what you call dynamic. And I would agree with that. So a specific question is, given one of your buckets is cash, but there's opportunity now in certain industries, if you have the experience, the time, and a bit of guts, are you deploying some of that cash cushion towards distressed opportunity?
The answer is that somewhat, okay? We always want to keep a certain amount of cash for a crisis. a potential missed opportunity is not a crisis. Having to write a check to keep an asset is more of a crisis. So the question, as I hear it, as it would relate to me, is am I adjusting this portfolio to take account of new opportunities that showed up because of COVID? Where are the levers? Okay, so here's the answer. So one thing we would like to increase our allocation to, given COVID, okay, are certain sectors of real estate, okay? When we speak with our real estate managers, there's incredible disruption in certain sectors. So we are looking to find, we're working with them now, people who are extremely good and have been good in, for example, the hotel sector for the last many decades, okay? So we would add perhaps a fund or two. We're not talking about changing 10% of our asset base here, but we would definitely and are definitely start looking to do more real estate funds, especially with people that have expertise in the areas of real estate that have been hurt the most. So where do we get the money for that? Well, the first is we do have dollars coming in from other businesses we have. So that's one source of those dollars. The second is that we could reduce by a couple points our long equity allocation to get dollars for that. The other thing is that our real estate that we own is continuing to make cash distributions. So the portfolio continues to generate cash on a quarterly basis. So that's a source of dollars for that. Another potential source is that our private equity funds tend to distribute more than we contribute on a capital call basis at the moment. So that's another source of cash for that. And when we look at our hedge fund portfolio, which is give or take 40% of the allocation, we could easily cut that back by a couple points to create cash for these types of new COVID opportunities that are presented. The hedge fund situation, though, helps us do this without our having to do anything. What do I mean by that? We invest with managers that to a large extent are in the credit space, and they adjust their portfolios to take advantage of this. So right now there's a lot of interesting things happening in terms of buying debt, buying mortgages, and without our having to do it, our managers are doing that with the capital we've already given to them. So it's part of their mandate. So part of our ability to exploit, post-COVID opportunities is A, our managers are already doing that because that's their expertise, and B, the types of adjustments we will make by seeking out new opportunities. I gave you one example as hotels. There could be quite a number of others. And I gave you some hints as to where we would take it from the portfolio if we wanted to move it out of some other categories. We would be talking at most probably about a 5% swing on the portfolio here.
I'm assuming you're not as concerned because you're patient, but given that you brought up real estate and you mentioned earlier, mainly multifamily, I could make an argument either or. The New Yorks, the LAs are going to be the new world order or more digital. We could move anywhere. Some of the social unrest issues, regulation in New York, taxes in New York, effectively bound to go up, and the appeal of other areas, Florida, Texas, etc. Normally, you're correct. Multifamily would be among the more conservative bets to make. Also, millennials are buying less houses. They're getting married later, having smaller families. But again, there's a positive and there's a negative. Are you a little concerned, not in the next 2 or 3 years, because that may get ugly, but are you concerned 7 or 10 years out that multifamily in certain big cities may never fully recover?
I'm concerned now. I would say that, first of all, I'm extremely sympathetic to the picture you just painted. Okay. One way, and that picture basically is that, things collapse. Businesses collapse, states can collapse, countries can collapse, financial systems can collapse. And I'm extremely concerned over the notion that the migration of wealthy people from northeastern states to the South will very substantially increase due to the fact that no matter who wins in November, I think it's likely taxes are going up. Mm-hmm. I think that it's likely, although I don't know, I think it's likely that the SALT deduction will be put back in. I'd be very surprised if the SALT deduction would be put back in for people that make a lot of money. So there's quite a possibility that the New York City resident, the wealthy, are going to be paying 55%, if not more. New Jersey, you'll be in the 50s. And so I absolutely agree with your view that there's a real concern right now. As, for example, I would not buy a general obligation bond from a blue state. I mean, why would you? I mean, that money's supposed to be there. That money's not supposed to be thought of as to whether it will be there. And one day, a court's going to decide between the cops and the bondholders, and I'm going to tell you now, who's going to win that fight. Okay, so the point about the cities and the geography and what you're pointing out is extremely relevant to us, which is why virtually every multifamily property we've bought in the last 5 years has been in the Southeast.
Yeah, no, those are all good points. Certainly, we could do a whole hour plus on real estate,
Yep.
but let's move on a little bit. So
Sure.
families in their allocations often make a decision depending on their fortitude for it, their internal teams, to be either direct investors or allocate to third-party managers. Now, I'm being a little extreme. The reality is most families do a combination of both. With direct, you have, I guess you could argue, complete control. You have transparency. You could do more direct hedging if that's your thing. But especially if you're investing directly in private companies, do you really have the internal team of either former PE and investment bankers, probably costing you millions and millions of dollars, them getting paid compensated properly? We spoke about this issue last night in a podcast that I hosted with Christy Kiegler. On the other hand, if you go to a manager, a lot of them, especially some larger PEs, are underperforming. Your money's locked up. You have no control. The fees could be onerous. You're expecting an illiquidity premium, but in reality, are you really getting it? So there's lots of questions in terms of being a direct investor, especially in private companies, or being more of an allocator to the pros, quote unquote, the third-party managers. What do you lean towards, or what would be your benefits to each?
Well, we really don't have the ability to be direct investors for a whole bunch of reasons. Number one, we do have complete transparency. If a manager won't tell us what he's invested in or she's invested in, we simply won't go there. Number two, we can hedge. We know which of our managers do hedge. We know which of our managers don't hedge. We know the degree to which they do hedge. So we can accomplish the transparency and the hedging. We, at this point in time, are not interested in running operating businesses. Okay, we don't want the responsibility. We don't want the teams. We don't want the entire infrastructure. We are extremely comfortable finding very, very talented people in these different sectors, and in a sense, letting them work for us. Okay, we don't invest in firms that have exorbitant fees, so the fees to us are not really relevant. Hedge funds don't come without fees. Other firms don't come without fees. If we don't think the fees are fair, we simply won't make the investment. We look at the fees as just part of the landscape. When we can get better fees, we try to. Generally speaking, the people that will do the best job on your money won't necessarily, cut fees. So we are not really cut out to be, nor do we want to be, a direct investor taking control of companies, because we think that that is an incredibly important and time-consuming and responsibility-assuming activity. That's just not what we want to do right now. And I would suspect that most family offices probably don't want to do that unless their business was to have many operating companies, and then they continue to do that at the same time. We're a family office that grew out of a fund of funds business. We still run the fund of funds business. So in that sense, we still have the fund of funds business at the same time as running our family office. But in terms of our buying a company in a particular sector, running the company, that is not for what we want to do.
And Marty, I'm going to look at some of your 8 allocations. We're not going to have time to go deeply into all of them. We already touched on real estate to some extent, but some comments on what you said or questions. So your long-only portfolio, yeah, you would look at the last 10 years and say probably being passive net of taxes and fees worked out better. However, we're now in a turbulent dislocation where active management may provide a benefit even with the fees. And at minimum, even if you want to be more of a direct investor, but as in publics, which is easier, as opposed to ETFs or separately managed accounts, could you identify certain companies like a Walmart, an Amazon, a Netflix, a Shopify that are likely to do well in this environment and be more concentrated in some long-only positions?
Yeah, sure. Well, when I talked about index versus active versus passive, that was in a theoretical observation. Our family has not used index funds. We've had money with one particular long-only firm on the value side for a very, very long time. So we've always come out on the active management side. And so, although we missed most of the fangs, so there's one of my 100 mea culpas for the moment. We have a few of them, but I absolutely agree that given the disruption right now and the fact that there can be many more, a big disparity between winners and losers, that there's a very strong case to be made now that people should tilt toward more for active managers than for passive indices. So people that make that point, I think they're making a very, very good point. Someone said to me earlier today, I haven't checked it myself, but he's pretty smart. He's usually right. You can let me know if it's right. He said over the last 5 years, the Russell 1000 growth was up 80%. The Russell 1 value was up 8%. I don't know whether those are the right numbers, but there's been a major disparity between growth and value for quite a while. So there's a lot to be done there. I'm sure 2 years ago, people were doing relative value trades where they were shorting the growth and long the value, and another 2 years went by. But I think that there's a very, very strong argument today for active management as opposed to an index fund. It's just you have to find the right active manager. Over time, 7 or 8 out of 9, or 7 out of 8 or 8 out of 9 active managers did not beat the S&P, right? That doesn't mean that people don't keep searching for them. When I was chair of a university investment committee, our CIO did. I think, short story, I think there's a good case to look for good active managers now on the long equity side. So I agree with that.
You probably knew I was going to ask this next question. We indirectly just answered it now on the long short side with potential for active management. But that core question is going to be, wow, 40% to hedge funds. Now, you've been a professional hedge fund investor for decades, so that's going to play into it, your connectivity, your knowledge in the community. But that is a huge percentage relative to most SFOs, which have come down from probably a peak about 10, 15 years ago, a 15% allocation, to probably closer to 5 to 7% now, as most hedge funds have become more institutional, placating to the non-taxable crowd. But yes, I don't want to limit it to long short. There's merge arb, there's distressed credit, there's even black box, which we didn't get into. Why is your allocation so large there?
Well, first of all, because I look down before I look up, if you did an analysis, well, when we do the analysis of the long-term track records of managers who are in, let's say, distressed credit or activist credit or whatever, okay, over long time frames, these managers, and one of our managers for 20 years compounded at, let's say, 10% net versus a 5% S&P. So that's going to be from the beginning of 2000 or so, with 2/3 the volatility. When we look at the activist equity and the credit space, although the last couple of years the returns there have underperformed, that's true. In fact, almost everything's underperformed. The long equities from the beginning of this decade. Okay, but when we do the long-term analysis, we believe, it's been our experience, that the right hedge fund picks, especially in the credit space or the activist equity space, have generated over long time frames better than the long-term return from equities, with much less volatility. So in short, that's the answer. Now, the other reason we have so much in hedge funds is we were very fortunate to be in a couple of funds who have done phenomenally for a very, very long time. So one of them is done in the 20s. for over 25 years. And so one of the reasons the allocation is that high is because one of the sources of family wealth has been being with the right hedge fund managers for decades. And we stay with them as long as we think that they can continue to do well. So the hedge fund allocation is a function of a couple of things. Number one, the analysis over time is that I can get better than equity-like returns with a lot less than equity risk. And number two, there's been a couple of phenomenal wealth creators in that space that we've been fortunate enough to benefit from. We don't do quant. We don't do highly leveraged strategies. We tend to stay away from macro. We tend to be simplistic investors. So we want managers who are doing fundamental analysis on a stock-by-stock basis, having the ability to short when necessary, and for all practical purposes, not using any leverage. So that's the reason for the hedge fund allocation.
And you just answered one of my next questions. You don't do quant, so-called quote unquote black box. I'm assuming because you like transparency and know exactly what they're doing, it's something you're not as familiar with. And again, they tend to be a little secretive. You don't know their secret sauce. Would that effectively be the main reason?
Yeah, I mean, look, we know some people that are, not many, but I know some of my friends are extremely good at quant. It's just something that, being simple, we can't get our arms around. And we feel that using the strategies that are basically fundamental, bottom-up, unleveraged strategies in the various asset classes we've discovered, if we can achieve our purpose with that, we just would rather not get into things where we just don't have the same type of understanding of what's creating the returns.
And one asset class you didn't mention, but you hinted at your feelings when earlier on you spoke about gold. How about commodities?
I read a book many years ago. It said that if you invest in commodities long enough, this person could guarantee that you would eventually go bankrupt. Okay. It's just not something we understand well. I don't know that you can actually do fundamental research on the price of oil. I mean, people invested in oil, and how many people would have thought a year ago that we would have seen this drop in the price of oil? So it's not an ability to do fundamental research. Most of the people that invest in commodity trading are really doing, various algorithms on, trading patterns. And if people can, have made a lot of money doing that, then, that's great. But it's just not, it just doesn't fit what we think we can understand, and what gets us comfortable. We view this as, as a marathon, not a sprint. And we're desperately trying to avoid permanent capital loss in any different area. And as I said, if one year we only make 7, pick a number, when everybody else is making 10, okay, we'll make it up next year. We're just not, we're much more worried about the possibility of permanent significant capital loss than making an extra point or two on the portfolio.
Given the 8 buckets that we'll say that you're investing in, and given the current COVID-19 times, if you had to pick one where you're going to be allocating more to, which one would it be? But the follow-up, that means you're pulling money from something else. What are you lessening your allocation to?
Okay, well, the answer as to where we'd be adding money, we'd be adding money we'd be adding a little bit more money to the distressed credit managers. Okay, we already have a robust allocation there, so we might be adding a little bit more, but we would definitely be adding money to those sectors of real estate that have been hurt the most. And we might be adding a teeny bit of money in the VC space for smaller companies that are definitely benefiting from the COVID, but that would not be a material allocation. Where we'd be taking the money from? Well, first of all, we do have cash coming in. The portfolio does generate cash. Okay. So instead of, for example, maintaining the lending position at, let's say, 7 or 8%, we might let it stay where it was on an absolute basis and take those dollars and throw that into those particular, areas I just described. We could trim the equities, but probably not that much. So I would say that we would basically adjust the portfolio by the cash that the portfolio generates and allocate it into a much more narrow band of those particular areas.
And sidebar for a second, I'm going to ask Marty very shortly about, given that investing in third-party managers is going to be how not only himself, but how most successful families and SFOs at least primarily invest. The little bit of the sidebar is I did a couple of months ago a podcast with Rishi Ganti that was very, very detailed about manager diligence. And I did note in that podcast, I'll remind everyone now, that we commissioned Rishi and I worked with him, but he did the heavy lifting to basically write about a 50-page ebook on manager diligence. Those that happen to be listening live or hearing it, just email me. I'm happy to send it to you. But on to that question, Marty, and again, you're a professional investor, having been in this industry for many, many years. But in general, if you had to speak more broadly to families that might have made their money in a different industry, had a liquidity, now whatever, $500 million, $1 billion, $10 billion, they have a good team, let's assume that. What would be some tips you would recommend on manager diligence?
Oh, well, first of all, Angelo, if you have a $10 billion family, you should send them my adoption papers.
Okay. Yeah, me too.
Look, the first stage in investing is, do you want to be in the strategy? Okay, so for us, when we do diligence hedge funds, for example, we know which strategies we want to be in. Okay, so we don't do due diligence on different strategies. We've already made the decision. I want to be in distressed credit. I don't want to be in quant. Okay, at that point in time, it's who's the best implementer of that strategy. Okay, that in that area, it's not all that difficult because people tend to know who the great managers are. Generally speaking, we're very sedentary in terms of we don't jump around a lot. Let's talk about, as an example, for a new manager, real estate. Okay, so how do we do diligence to manager? So a lot of it's very basic. One thing that we do is we do background checks of two kinds. We check public records, and we have another person who's extremely good at checking the stuff that other people aren't supposed to know about. So we do background checks on the people. If there's any issues there, we just walk away. We have a very, very robust operational due diligence approach. So my CFO studies whether people have administrators, whether they have auditors, who the auditors are, what the valuation policies are, do they have third parties, what the securities are the securities susceptible to valuation manipulation? Are they public securities? So we do a very, very detailed analysis from an operational due diligence perspective. What the whole internal structures are of these businesses to see whether their operational components are good. Generally speaking, they're usually fine, because if they weren't, they wouldn't have gotten the money they've gotten so far. That would not have been true 10 or 20 years ago. It's much more true today. And to a very large extent, I mean, we're looking in the hotel space. So we know one fund of a number that we're looking at. So I have someone, a very close friend of mine in the hotel business. I call him up. I said, you know these guys? He said, not only do I know these guys, but I'll invest with them any day of the week. And this comes from someone who's been in the hotel space himself as his main business for 3 decades. So that we look for data points like that about the people. And then we want to understand if they're going to be in the hotel space, whether they're going to take equity positions, whether they're going to, just be preferred equity, whether they're going to just buy debt. So those are the traditional boxes, that we check. It's very, very people oriented. Once we've decided we want to be in the space, it's very, very operational, due diligence oriented. It's background check oriented. And so those are the different types of ways in which those are the things we think about when we go to do manager due diligence.
And in terms of broadly hedging, so some people may say diversity, time on your side, liquidity, cash. A little bit more complex would be to do specific strategies around evaluating private positions in private equity, CAPM, beta risk, and then doing option and put strategies on various indices. So that gets a little more complex, and right now is very, very expensive. You're probably going to know that you're so heavily allocated to hedge funds that should be hedging risk, and you know them so well that you may be getting enough hedging coupled with your liquidity with that. But do you do anything specific to hedging?
The answer is no. We know that we don't have to hedge our cash on our bonds. Okay, we don't try to hedge our equities. Someone did a great study that over 30 years, you made 3 times as much in an S&P index fund as you made in a 30-year treasury. but if you were out of the market the wrong 5% of the time, the returns were the same. Okay, so we basically view our equity book as a non-hedged equity book. When we get to the hedge funds, we have a couple of different ways we hedge. The first is we have certain managers, I'm sure many of you know who I'm talking about, who always hedge and rarely have a drop of more than 1 or 2%. Okay, so that piece of our portfolio is extremely hedged. We have other hedge funds that are in the credit space, and we know that they're never going to have impermanent material capital impairment because there's no leverage, and they don't go too low in the capital structure where they're going to get wiped out. So we don't need to hedge that, even though that particular piece of the hedge fund book will have short-term mark-to-market drops when levered credit managers are getting blown up and taken out, like in 08 and 09. So some of those managers were down in the 20s in 08 and up in the 80s or more in 09. So we don't hedge that, but we control the risk. There's a difference between hedging and controlling the risk. Hedging is controlling the short-term volatility, and controlling the risk can allow for some short-term volatility as long as you're not looking at any significant, if any, loss of capital. Permanent capital loss. We don't need to really, the hedging of the lending is just getting the underwriting right, being unlevered, being in the first position. The individual real estate properties are very, very non-volatile in cash generation. And the VC really doesn't require hedging in the sense that those are long-term bets. And so incurring short-term volatility, assuming it would even show up in the marks, would not be something that would be of great concern to us. So we do have some hedging, which is done by the managers. We don't have any of our own overlays. And to a large extent, where we're not hedging, we are significantly controlling risk by the nature of the strategy and the lack of the leverage.
I'm going to mention a couple of more esoteric asset classes. You didn't mention them, so maybe you have some one-offs, but for the most part, your opinion, and it may be you don't know it, there is no opinion, we're not invested. One would be cannabis.
It's just not for us. I mean, I don't know how to figure out the political risk of that. So we've just decided to, for all practical purposes, avoid it.
And how about crypto and blockchain?
We don't understand that. You know, I went to a couple presentations, you know, on you know, putting your wealth on those systems and how nobody can steal it. And then I read about someone that had 500 million on it and he forgot his password, so he's going to hypnotist to try to remember it. And then when someone says nobody can break in, I remember watching the old Westerns, you know, when I was a kid, where they couldn't open the safe. So the bank robbers took it to a gigantic cliff. And they dropped it off a safe. And when they dropped it, it finally opened. So I'm not so sure there are safes that are uncrackable. So we just decided to pass on all that stuff.
Understood. And is there any, what's the word I'm looking for? I don't know about the word pressure, but impetus of the younger generations that are socially aware, climate change issues, et cetera, that want the portfolio to have more of an acceptance and allocation towards impact investing?
Well, if they tried to do that, I'd probably disinherit them. We don't do any of that type of investing. If an investment makes sense, and if it has those additional effects, that's great. But we don't allocate capital on social impact bases. We give away money with those ideas in mind. We have a charitable program where the only factor is, you know, shall we say, doing social good. Okay, that's the purpose of the philanthropy. But we don't invest on that basis, because that's not what investing is for. Investing is for you know, maximizing profits from our view, so you can therefore have more money to do social good with. So the short answer is we really haven't focused on a lot of that.
I'm going to go back to an earlier topic, then I think we're done. real estate. So you mentioned a longtime investor for many, many years. And when I asked the question about 20 minutes ago, you showed some concern about multifamily, at least in given regions. And I believe I agree with you, rightfully so. Yet a little while after that, you mentioned looking to put more allocation towards hotels, which seems incredibly risky. What's making you have that juxtaposition?
The only reason that, and I would say that if we made a hotel investment, it wouldn't be in, first it would be in funds. So we had it, okay. I would say that the most that allocation might become would be a couple % of the family net worth. It wouldn't be 10 or 15. It might be a little bit. The short answer is that there has been a major crash in that sector. There's been complete devastation in that sector. And in the event, whenever there is a crash and there's major devastation, there's always opportunity, okay? And so we're looking to perhaps look at either hotel or retail, not, as we say, qua hotel, but qua an asset class that just had a disastrous event happen to it. So it's simply just the form of value investing that in this particular case showed up in the hotel and retail sector. That's the only reason that we would take a look at that. If another part of the world completely crashed, we might take a look at that as well.
Well, this was a great discussion. I really, really enjoyed it and appreciate your time. A reminder to those that are viewing it live, viewing it in the future, or a podcast, whatever. Obviously, being an investment-centric discussion, it's very applicable really only to family offices, significant qualified purchasers plus. And we're talking in late July of 2020. You may hear this 3 years from now, and so much of it has changed. You need to be specific to your risk tolerance, your liquidity, your specific needs. This is simply for education, and I would even say entertainment, but you need to see your own professionals and make your own diligence and decisions to anything pertaining to investing. Marty, for those that may have an interest, if you even want to, there may be no motivation for you to, but those that have an interest in wanting to follow up. Now, again, you do still have an interest in an operating company that's effectively a fund-to-fund, so a professional investment service. Did you want to give out either a website or an email where people could connect with you?
Sure. Just email me at the email is mjg at sandalwoodsecurities.com. And I'll give it to you. So if anybody wants it, you can have it as well.
That's very kind. Now, again, as this goes in time to a podcast and thousands of people, I'm so fortunate around the world can hear it. Hopefully people won't be emailing you looking to sell you stuff. But that's where you have a good, hopefully, executive assistant to kind of weed through all of that. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast on Apple, Spotify, Stitcher, iHeart, and other platforms. My YouTube channel, where we encourage you to subscribe and where a fair number of these videos make it up, is simply Family Office. So it's a great name. I registered it years and years ago. And I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great success and their family offices, doing a significant amount of original proprietary content, hosting global digital programming, hundreds of them throughout the year. So we've been incredibly busy. I've never been so busy as I am during COVID-19, and lots of other initiatives from masterclasses to various aspects about building a resilient, anti-fragile family office, which you'll be seeing in August, a lot of our content coming out. I'm very active on social media. You could find me. Website is familyofficeassociation.com. Unfortunately, if you're a live listener, it still is my dated website. The new one, I'm hoping in a week or two, will finally be up. If you're hearing this in a podcast, likely the new one will be up. It's much, much better than the one I have now. And my email is angelo@familyofficeassociation.com. Thank you all for viewing or watching in. And Marty, thanks for being such a great guest. Thank you.
Angelo, I really appreciate it. Someone just said they missed my email. You have my permission to give it to anybody who needs it, okay?
And if you don't mind, though, could you read it one more time?
Sure. MJG at sandalwoodsecurities, one word.com. SANDAL woodsecurities.com.
And yes, if they also reach out to me, I'll be making sure to help on that as well. Everyone, thank you so much. Thank you.
Thank you all. Take care. Bye.